All right. Good morning, everybody. So we got a little bit of pullback. Palantir knocked it out of the ballpark, and yet the look down the road was enough to give the trading desks what they've been wanting, which is an opportunity to unite in their anticipation of a pullback. It's interesting if you caught it on Bloomberg, they're talking about a 10% or more pullback within 24 months. that that's a really big margin for error. And of course, everybody is getting excited about that pullback as if it's going to happen today. We already had a little bit of a pullback. We'll see what we get out of it from there. But temper your enthusiasm for shorts because, well, we've still got a long ways to go. There's just no other way to look at it besides that. Even if the whole run is over, which I don't think that it is, it's very likely that we won't get a direct shot to the downside, right? We're going to work our way down. So just moderate your enthusiasm for shorts. NASDAQ down 1.25, Japan down 1/4. Everything else mixed between those two. The Dow at 0.5, the S&P down 1%. And even small caps is keeping up with the NASDAQ on their short side. Just a little bit of a pullback. Wash things out a little bit. We're not going to get a lot, right? All of these are dependent on a government being open. So we're going to get Bowman, but we won't get any of these numbers. I think tomorrow we get ADP, though. I don't think that it'll be interrupted, so we should get those numbers. We do have a White House briefing anticipated today at 11 o'clock, well, at noon, because this is my local time. Not a lot to the upside today. Looking at the things that are down, nearly everything is down. So, we finally got a high correlation coefficient. Yay. It's too early in the morning for those big words. This is the CTA positioning that I've continued to highlight and point out. They got out of their most extreme, and now they've just been holding out. It's worth noting that they're not dumping their positions like crazy. They're in hurry up and wait mode. Even after the new QRA proposals from yesterday, we're still in this pause, right? They're not dumping it like crazy. You can see previous examples of what it looks like when they GTFO, and that's not what they're doing. So they're just hanging out. They're not allocating back to their previous exuberance, but they're not getting risk out any more than they already had, and they're just holding the line. So, keep an eye on that. Vol funds are going to have to start responding if the VIX climbs above $20. So that's something to keep in mind as well. They are non-discretionary trading firms, so they don't have a choice. They will do what the VIX tells them to do. And old Michael Burry, the famous short guy, the one that was really credited with, the making the most money during the great financial crisis, has placed a $1 billion short bet based on AI feeding itself and running out of food. I mean, I thought I traded with some decent size. I'm not running, billions in asset under management, but ooh, that is some size right there, right? That puts it on a whole other level. So one thing you want to keep your eye on is the dollar at this point. The dollar is a little tricky. It's not like the VIX. When the VIX goes up, we generally expect the markets are going down. And that's usually why it does go up, is because the markets are going down. So generally, the VIX isn't the reason the markets are going down. The markets go down and the VIX goes up. But either way, when we look at the VIX, we got a pretty good idea that it's supposed to move inverse of the market. The dollar, not so much. Sometimes having a dollar go up is a good thing, and sometimes having the dollar go up is a bad thing. And you have to analyze each time in different regimes, why is the dollar going up or why is the dollar going down? And right now, a dollar going up is a bad thing. It is going to weigh on equities. It will make a rally in the market less likely. I don't want to say that a rising dollar is going to send us lower, because that's not exactly the dichotomy we're dealing with. But a rising dollar is headwinds. I think that's a fair way of saying it. And so as long as the dollar continues to push higher, we're going to struggle in the S&P and the NASDAQ to also go higher. We want the dollar to stall out, quit rising, and or turn around and go back. But no matter what direction it goes, the rate of change in the dollar, how fast it's moving, is also really important. So while I just said we need it to go down, we don't want it to go down fast. Nice and easy. No big sudden moves. Nothing that's going to scare anybody or, put us into a crisis. It's really worth considering what we're going to do and what the swag levels are going to be. So let's just jump in there a little bit. We're on a daily. The next level of interest is going to be the 101 and then the 101.5. Cutting back down where we came from, getting back below 100 would be a good start, and then 99.5. Those are just swag levels, right? The main thing is that it stops moving. And there is something called the 5-bar rule. I mean, I don't know if you subscribe to it or not. Most of the time, markets will exhaust themselves and they need to take a break. So this is day 5 of one color. You could have an expectation that tomorrow we'll get a different color, but it doesn't have to, right? The rules are meant to be broken. And right now, 99.8, even though it's not a nice, clean, round number like 100, and it's not sitting in a quarter like 99.50, 99.75, I guess we just knocked that 4 off of there. Or 99.8 would be a particular line in the sand I would keep my eye on. That is the open from the 3rd. It's the low of today, basically, not to the tick, but you get the idea. Break that, and we could pick up speed to the downside. Just remember, we don't want it falling too fast. We also don't want it to continue to rise. On the weekly, you can see we got plenty of room, right? Plenty of room to the upside. So with the 10-year, we're sitting inside of this range. This is also daily. When your IX10 like this, inside of a really wide bar, there's not a lot of excitement for it, right? 'Cause it's not like it's some signal of compression or anything like that, because it's a really wide bar. So we still got a GTFO, but as long as we're in this space, then we're good. We don't like it being elevated like this, but it's all right. We'll make do with that. No swift moves, and staying inside the box would be a good thing. For a tell on what to expect with the 10-year this year and what we need out of it, look back to April and consider how nasty things were before the bond vigilantes pressured the president to change his stance, and then that rally up. So the 10-year went up, the markets went up, things turned around, they got better. When they were at their worst, this was down, the markets were down. So this isn't always the way the 10-year is going to work. The 10-year, just like the dollar, is one that you need to evaluate. Kind of asking the question, what do we need during this situation, as opposed to just something like the VIX that always has the same kind of connotations. So a rising 10-year is a good thing, as long as A, it's not going too far too fast, and B, it doesn't exceed some critical levels. Right now, the critical levels to exceed would be the daily expected ranges, right? Moving too far too fast. And then getting above 4.5, I think we'd start to get into some trouble once we get above that level. But it's a long ways off, and we certainly don't want to get there in one day. And we're talking about bigger picture stuff. So GTFO, got to get out of the box. The dollar's the one to watch, though. The 10, I don't really expect that we're going to get much out of the 10 on a day to day. Just broader, bigger picture. Keep your eye on the 10. Call wall, put wall did not move again. I don't know how many days that is now that it's in the same spot, but it's in the same spot. So no change there. If you look at the ES on the daily for a moment, we finally got that gap closed. Yay. And we've tested the 20 period daily moving average. We don't yet have a surge signal, but we have the first piece. A surge signal is when price crosses through the 3 and the 10 and then drags the 3 through the 10. Well, we got the price cross. Now we need the 3 to cross. Once the 3 crosses the 10, since we're headed down, this will be a bear surge. Once we turn everything around and we start going back up, it would be a bull surge. It's just a high momentum play, right? That's not high conviction, just high momentum. We didn't close under the 20, but the day isn't done. That's one thing to focus on. The last time we closed below the 20, the next day we immediately ran right back to the 20. Now, we didn't get above it that day either, but it's what we focused on for almost a week before we finally got above it and then buzzbeat off of it, and then we continued to do what we've been doing. So now the 20 is in focus. If we overshoot the 20, we're going to be looking at the 50. That's the 50-day. There's also the round number 50, 6750. I've said for a while now we're running 50s. So, we expect to break 6850 and go to 6750, pausing with a little speed bump at 6800. And that's what we're doing right now, is pausing on the speed bump. It's also this previous high. We ran through it as if it didn't have any resistance. And so far, we punched through it. We'll see what we get out of it. So, if we were using old school language like support and resistance, that's a support level. So's the 20. And so that's 2 levels of support. Then we got the mid of that breakout day. That's another support level. It lines up in the same spot. And it's a round number. That's another level. Right. So those are old school concepts. The idea of support and resistance, it's antiquated and broken. The more and that you can stack up, the better. So we're back to 0-day, 0 gamma. We've been having a lot of conversations about this lately, how there's 3 major players now, Mentor Q, Spot Gamma, and Volland, and they all got 0 gamma levels. They've all got these various phrases for the volatility trigger. And depending on which platform you're looking at, the numbers may or may not line up. So then, we start asking, well, which one's right or which one's more relevant? And really, it's in the details of that platform. Every one of them has educational background that talks about the tools that they use and how they built them and the time frame for those tools. And it's the time frame piece that helps answer the question. So depending on what tool you're using from which platform, it's going to be using different dates for the options that it's evaluating. Which is why you'll see different answers, plus how they get the numbers. Volland, for an example, carries every trade, right? They take it, internalize it, and they do a lot with the data that they get, which is why it's so expensive to gather all that data and then do something with it. Spot Gamma likes to give you the summary of their work. So they have their own proprietary little systems. They run it through that, and they give you their quant answer. Not exactly the same as the raw data answer. Every one of them does something different. Rather than comparing those tools to each other, I think it's better to treat each one individually and see what it has to offer. And then collectively look at all the analysis that you got from all 3 of them and build your analysis from that. Underneath the 0 gamma, we don't have anything else until we get to the 10-week, which is 6,700. Now, of course, we got the 6,750. We've got cog lines, measured move, all sorts of things that we can hit. But if we're looking for major moving averages or options levels, there's nothing down here. Overnight volume, 170,000. It's a bit more than we're used to. So they are not sitting out. They came in and they participated. That's about 100,000 above average, right? The average has been about 70,000-ish. So they came in a little heavy last night in that trading. We made the full ADR last night. So generally speaking, the phrase that we use is if we can get to 1 ADR early enough, we can go to the other side by the end of the day. Now, don't get me wrong. I know that sounds bullish because I'm pointing to the upper edge and, it looks like it would be a significant breakout to get there. That's not bullish. It's just the way that waves function, right? The wave goes up, the wave goes down. So when the wave is at the bottom of the trough and it looks like it's going to come back up again, it doesn't necessarily mean you're going to get a tsunami out of it. Just that the wave is likely to come back up to its previous top. Price is no different. So we're at the lower edge. Studies and statistics show that if we get to one side early enough, we can get to the other one by the end of the day. And that could lead us back to 69.32 cog line up into this red line here. But I wouldn't see that as overly bullish at this point. It would just be running us back. It is noteworthy that there's no market maker move this morning. So we're down, yeah. They came in and piled into the trading in the overnight. Yes, check. Are they worried? Nope. There is no additional hedging this morning. They're not concerned in the least. We are firmly below the weekly floor pivot. That puts us in a bearish bias. Today's daily floor pivot is slightly higher than yesterday's. We'd have to zoom in to see that. Higher is bullish, but it's basically in line, so nothing there. Price opened underneath it. That's bearish. And we've greatly expanded away from it after we've hit it. So there's no bias that says we have to go up to hit that level because, well, we've already hit it and we've left that zone. We got an inside day breakout with a really nice expansion. We've expanded farther than the entire day's range for Friday and Monday. It's a good start. We've already made S2. We stalled before we got to S3. And here's the rub. If we can't get back above S2, we're going to S3. Right? That's how it works. So we need to get back above 68.21 to have a chance of getting back to the floor pivot to work on that breakout and get above 69.11 cog line to get into 69.32 cog line ADR top. But if we can't break 68.20, then we're going to break 6,800 and get down into that 67.50 or S3. One thing about these S&R lines worth noting is we've had compressed days, and that compresses the levels. They're not as far apart because we haven't really had expansion days. If we open this thing up and we find a day where we had really big expansive days, like this day, the 29th, we had a pretty big range that day. The next day, the range on this indicator was really big, right? So we've expanded really big today. Tomorrow's range is going to be really big, but we're still using the range that we have on the day, which was based on a narrow range day. And so the S&R levels are a lot closer. They're easier to hit. Getting to S3 sounds extreme, but since we've been running in a compressed range, S3 is pretty easy to reach. All right, we're starting to build out that classic P-shaped profile. We need to see what we do along this low and whether or not we build out a second distribution here or if we're going to leave it thin and run back up again. At the moment, it is thin, so it is that P-shaped profile. If we stay down here and build another distribution, then we'd have a double distribution. Market wants to get back inside of this value area. So if we can start that run to the upside, 68.11 cog line, 68.32 cog line, that gets us in the shallow area. We can move through the shallow area relatively fast. and then that can get us back inside the value area. This week's point of control and last week's point of control are on top of each other. That 68.87 area is a significant level of resistance to work through, but we're a long ways from it. Look left, we've got this 67.87 zone. It's this point of control and that point of control. Just run your box through both of them, and that's the zone that we've got down here. If that breaks, 67.50 is where we're headed. $10-day, 30-minute volume profile and TPO. The idea was that we could narrow our range as the week went on by wiping out these candles on the left, as long as we didn't go down and put in new candles. Now, at the moment, we're still in the lower edge of the value area, and as long as that holds, then the value area is likely to be the entirety of our range. It'll look like this by the end of the week, but it needs to hold. If we break that low, that value area, and we put in some work in this zone, then that zone is likely going to be the new point of control when the point of control finally does move. We're looking at least a week where it stays where it is before it moves. There's no indication or reason to believe it's going to move any sooner. So that's just another big level over our head to deal with. And we're not likely to get any help or support out of it by getting it underneath us for at least a week. We hit the VPOC that we had marked out from Friday. We're done with it now. And we hit this one from the 24th in the overnight. You know, when it comes to these levels that we hit overnight, you can take them off as soon as it's been hit. There's nothing wrong with that. But I'm going to leave it on all day. I want to see if we go back in that direction, how price responds at that level. I'll end up taking it off tomorrow in the live stream. So it is hit, it is done, but since we ran it through in the overnight, I'm willing to see how price responds to it if we move back in that direction during regular trading hours. We still got another one below too from the 23rd, 67.74. So a continued move to the downside. 74 would be a stopping point before getting to 67.50. Looking at the point of control from last night, the VPOC that we took out, it didn't really cause anything more than a speed bump, but that was a first touch play. The TPO and the volume profiles point of control this morning, they line up almost perfect. The value area is a little off. It's not quite a B shape simply because of the distribution that we've got up here. But yeah, I mean, it's arguable whether this is going to be considered a double distribution or not. That is a distribution. It wasn't a nice thin profile, thin stock. So I'd say it's a minor distribution up there. And if we make a run to the upside, it might be worth marking out yesterday's point of control. We started there, so technically it's been hit. But, you know, we mark these levels as a place where we anticipate trading activity, right? Elevated trading activity for whatever reason, trader's remorse or unfinished business, whatever you want to call it. Since we barely put any work in at that level, My expectation is that if we get back to that level, whether it's today, tomorrow, whenever we finally do get back to that level, I think we're going to see a response there and that it's worth marking that one out. So I don't know if you technically want to call that a VPOC since we opened on that spot. It technically has been hit, but we didn't put any work there. We are below the 10-day by about 0.5%. We talked about those collars, the imaginary levels that are around the 10 yesterday, 0.5% above and 0.5% below, and then 1% above and 1% below. If we're 0.5% below the 10, that's nothing. We're still in a good, healthy place. There's nothing wrong with our position. Even if we get 1% below the 10, at that point, it's still not a bad thing. We need to get those pullbacks once in a while. If we start getting below 1%, then we got things to be concerned with. And if you look at -2, which is just about where I got my mouse, we don't usually hang out below -2 for long. And when we do, it's usually connected to some continuing drama, like the tariffs when they were first announced and that put us down, or the 2022 bear market, right? Something that is sustaining that negativity. Otherwise, we generally drop down into that zone and then we pop right back out again. We have not yet hit the edge of the weekly expected move, depending on whether or not you hand drew the lines. So let's kind of nerd out here for a minute. This indicator is supposed to be gathering the Friday's locked position of the expected move. The problem is Thinkorswim doesn't give us access to any code that can actually get these numbers. Now, right now, these numbers are moving, right? It's not the Friday locked numbers. Sunday night, when the market opened back up, these numbers started moving and it hasn't stopped, and it won't stop. So I don't know how he did it, but Mobius designed that indicator to approximate these numbers. Obviously, getting them by hand is way more accurate. And if you're only looking at one or two products like the ES and the NASDAQ, well, then that's cool, no problem. But imagine you're an equity trader and you want to look at the MAG 7, and then you want to look at anything that happens to pop up on your radar all week long. How could you maintain the weekly expected move on 75 to 100 products if you had to hand draw them over the weekend while that number wasn't moving? That would suck. You wouldn't have a weekend. So the indicator gets us kind of close, and it does a fairly decent job most of the time. But always, if you hand draw the lines, you will get a much more accurate and consistent answer. Because, sometimes this indicator does something goofy, especially right after new contracts, and it gives us no answer at all. So drawing them by hand will give you better answers, but be consistent. If you're going to do it by hand, always do it by hand. And if you're not, then, don't do it. Don't randomly decide one week to do it by hand. So we're not at the weekly expected move yet using the indicator. We'll see if we get there at some point today. That's 66. And keep your eye on the SPX when we get to the open today to see where the SPX opens at and if we're going to hit that. All right. looking at what's down today, everything's down today. Surprise. Things that are not down enough: cloud computing, healthcare, industrials, building materials, financials. Those are not down enough. That doesn't belong in there. They're moving in the right direction though, right? To stay on par with the rest of the group. So we don't really have any outliers from that. On a morning like this, when everything's negative, one thing that I like to do is gauge how negative is negative. Looking at those ETFs and ETNs give us an idea of the groups that are down, but not really the individual stocks in those groups that are up or down. What we're looking at here is the NASDAQ 100, and we're asking how many names in the NASDAQ 100 are down at least 0.5%. 67 names. Well, we can say that in a way that makes more sense. 67% of the NASDAQ 100 is down today by at least 0.5%. That's pretty bearish. 67%. But then again, we can still ask, well, what are the names that are down? And are they health technology, commercial services, chips, pharmaceuticals? Try to get an idea. And we can see all of the semiconductors are down. It's not much of a surprise. The Mag 7s are down. Industrials, machinery, pretty much everything, right? And we could look for outliers by flipping this indicator over and looking for any names that might just happen to be positive this morning. But the real thing that I come looking for is if we're really positive or we're really negative, by how much. 67% of the NASDAQ, that's a big number, right? It's a stock pickers market when the number's like 12 up, 12 down, and we don't really have anything going, and you got to really dig in to find something. But if that number gets into the 80s and the 90s, throw a dart at the barn wall, you're going to hit something, right? That's when you run your alpha protocol and you short the whole basket, or you buy the whole basket if we were bullish. It's been quite a while since we've been able to run the protocols. Looking at the S&P 100, asking the same question: how many names are down at least 0.5%? 57. All right, we say that another name. 57% of the S&P 100 is down today at least 0.5%. That's bearish, but not as bearish as the NASDAQ. And it's the number that we want to keep our eye on as we get into the open. Is that number continuing to grow and we're getting more and more names that are down below the half? Or are things turning around and that number is continuing to decrease as we get into the open? Now, once we are in the open, Thinkorswim has the Analyze tab under Market Watch where you can, the Visualize tab, under Market Watch. This heat map is awesome, but that's not what we want. We want the index watch. Choose your index. Now you can stack these up. You can make them into tiny little windows so that they don't take up much space. Choose your index, like the S&P 100 and the NASDAQ 100. If you make your own Mag 7, then you could put one in for the Mag 7. one for the Dow, one for the Russell. You get it, right? So once you stack them all up and the bell rings at 9:30, you're going to start getting issues. I know it just sounds funny. You got issues. Issues are companies. So how many companies are advancing? How many are declining? You can see their volume flow and their capital flow, right? What do they always say? Follow the money. So we could have 80% of the NASDAQ down more than a half of a percent. And then the bell rings at the open, and we see that there's still more capital coming in than going out. It happens, and that kind of divergence is a really good tell, but you won't see it unless you go look for it. And you can scrunch these windows up really nice, right? You can get them just as tiny as you want them to be, and they won't fall behind, right? Well, that one did because I didn't pin it, right? So you can pin them so they don't fall behind, make them just nice little windows, and that's your advanced decline. Be able to see how many names are up, how many are down, where's the money going. Of course, you could just use the ADS-PD for the S&P and the ADNDD for the NASDAQ. But that's a math formula, advancing minus declining issues, rather than just giving you the actual raw numbers, how many are up and how many are down. It does not owe us anything today, guys. It's already made the move. The work has been done. There's no reason to think that they need to come in and get anything else done. So bare minimum, this is our range, as wide as it happens to be. And we're just going to chop around inside of this range. That's the base case argument at this point, because it doesn't owe us anything. This is our Globex range. If we can get through the 68.32 cog line or the half back here, we want to get back inside of yesterday's trading range. If we come back down and we break our own Globex low, 67.50 is the first stop, 6,700 is the second stop. There's a 200 period moving average, a long ways off, but let's just work at one thing at a time. 67.50 and then 6,700, because that would be the 50 period daily moving average. That would be enough for today. So what I got for you guys, be careful, be safe, have a good day. Keep your eye on the clock. I'll see y'all tomorrow.